So in this video, we are going to cover the 9 most common tax planning mistakes that I see business owners and specifically LLC owners make. These are mistakes that I've seen my clients make, and when they rectify, can save them over $50,000 a year in taxes, depending on their business income. If we've never met before, my name is Ethan. I'm a certified financial planner and I'm your financial advocate. And if you enjoyed this video, hit that like and subscribe button so it can be shared with more people. Not only am I a financial planner, I'm also a business owner just like you and have made these mistakes myself. And I'm making this video to share them with you so you don't have to go through the same heartache, money loss that I have gone through and that I have seen my clients go through as well. So in this video, we're going to go from the least to the most costly tax planning mistakes that business owners tend to make. So we're going to start off with number 9, which is the least costly to you, and stick with me to the end because the last one and the second to last one are most likely going to be the ones that save you the most money when it comes to tax planning. So number 9, common tax planning mistake is waiting until April to figure everything out. I remember when I started my business, I would do exactly this, and I was going through receipts, I was trying to figure out what expenses were, and I just was not capturing everything that I could have, and I know that money was being lost. It was a huge mental drain and complete waste of time. Instead of doing this, schedule a mid-year tax planning session with your tax planner, CPA, tax professional, where you can look at things like adjusting income, making sure that your estimated payments are accurate, looking at potential purchases to accelerate for depreciation, and a ton of other strategies that if you wait until April, you're never going to be able to capture. So number 8, very, very common tax planning mistake that I see really successful business owners making is commingling expenses. This looks like having one debit card or one credit card that you use for both your business and your personal expenses. Not only does this break the corporate veil on your business entity that gives you legal protection, but it also makes it extremely difficult to manage and track your expenses and do good bookkeeping. When you go back and you're trying to shuffle through everything in April and you're trying to spin out what was a personal expense and what was a business expense, becomes nearly impossible to remember if you're anything like me. Keep your expenses separate. Have a separate business account and a separate personal account. Have a separate business credit card, have a separate personal credit card, and then make sure that when you transfer money between the accounts, you're doing it in the right way. And if you do need to make a personal expense, make sure you transfer the money from your business account to your personal account first, and then make the expense or the purchase from your personal account. Number 7, poor expense documentation. I see this all the time where business owners say, this was a business expense. I took this client out to lunch and they didn't have the receipt for lunch. They didn't have who it was with, what they talked about. They didn't have notes for that. It wasn't on their calendar. The reality is the IRS wants receipts and they want documentation to prove that it was a business expense. If you are not doing this, then you're not going to be able to capture the business expense if you are audited. You must capture these business expenses because they reduce your taxable income. It is the beautiful, powerful thing about being a business owner. The tax code is written in your favor. You're able to make money, spend money on business expenses, which reduces your taxable income. Unlike a traditional employee where you have to make money, your tax, and then you get to spend it, it flips the script. So make sure you document it so you can keep more of what you make and you can reinvest into your business in a way that allows you to make more money and expand and grow. Don't miss this one, because even if you know you spent the money, but it's not documented, it's still not going to serve you well if you're ever audited. Mitigate this risk. Mistake number 6 is missing your estimated payments. For many businesses, you're going to be making quarterly estimated tax payments. And bonus, if you live in Hawaii, it's also missing GET payments, which is a Hawaii kind thing. When you miss your quarterly tax payments or your estimated taxes, you end up paying more in fees. The IRS expects you to pay your taxes as you go and not just wait until the end of the year to pay and file. If you do this and you miss your estimated tax payments along the way, you are going to be charged additional fees that could have been completely negated. The fix here is to set aside 25 to 30% of your business income that is going to go to pay for taxes. Not only does this help you keep your business hygiene up, but it makes the emotional burden of paying taxes much easier. I can tell you it's easier to write 5 checks for $5,000 than 1 check at the end of the year for $20,000 plus fees and all the unnecessary expenses accrued by missing your estimated payments. Tax planning mistake number 5, paying yourself incorrectly. As a business owner, you have the control of how you pay yourself your income. You're able to choose between paying yourself a wage or taking distributions depending on how you structure your business entity, which we are going to get to in the next section. But understanding this is crucial to mitigating things like self-employment tax or QBI. You must understand the different ways you're able to pay yourself as a business owner, how they are taxed, and how they work into the various entity structures that are out there. Doing this is a huge tax saving opportunity, tens of thousands a year, every year for the rest of your business life. This is powerful. It could fund your retirement account if you wanted it to. The fix here is to use a reasonable salary that you can look up from industry standards or benchmarks. It's something that you're going to need to revisit every single year because your business should be growing, your income's going to be shifting, and you need to be paying yourself the right amount to reduce complete tax liability. Number 4 is choosing the wrong business entity structure. And this is one of my favorite ones to help clients or new clients understand early because it can save literally tens of thousands a year in taxes by filing a simple form and doing some administrative tasks that make complete sense and are totally worth the tax dollar saved. Most businesses are being taxed as a sole proprietorship because when you create an LLC, that is how you are automatically taxed. But you have the ability or the option to choose to be taxed as an S Corp or a C Corp, depending on what is most advantageous for you and the type of business that you're in. Very often, it makes sense for business owners to choose an S Corp entity election. This opens up the doors for being able to pay yourself a reasonable salary through a W-2 wage and then taking distributions as a K-1, which reduces self-employment tax. This entity election in and of itself does not save you taxes, but it opens up the doors to massive tax savings this year and every year after. It's going to be something that you need to revisit on an annual basis as your income and your expenses change, but it is a powerful strategy that should not be overlooked for business owners who have an LLC. Tax planning mistake number 3 is missing or misunderstanding the QBI deduction. The QBI deduction allows you to deduct 20% of your business profits depending on what type of business you have. So you have to make sure that your business is actually qualified for QBI, which most of them are, and then you need to understand the phase out limits of QBI. This year it's around 182,000 as a single member where you begin to phase out of your QBI deduction. It is important to balance your QBI deduction with how much income or salary you're paying yourself through a W-2 wage if you've made this S Corp entity election, because there's going to be a trade-off between saving on self-employment tax at 15.3% and QBI at 20%. Finding that balance between the two is crucial, and understanding QBI, whether you're getting it, not getting it, or not optimizing it, can really help you save tons of money on your taxes. This can be one of the most valuable 30-minute conversations that you have with your tax planner or strategist through your mid-year tax planning meetings. Tax planning mistake number 2, one of my favorite ones as a financial planner, is ignoring retirement contributions. As the business owner, it is on you to establish your retirement accounts. You don't get handed a 401k like a normal employee, but this gives you control and power on choosing what type of retirement account to establish, how much to contribute, and really allowing you to manipulate your income by using tax advantaged accounts. There are tons of options out there for retirement accounts that you can set up as a business owner, but my personal favorite for many business owners is a solo 401k that does have specific restrictions that I'm not going to get into in this video, but will allow you in 2025 to save about $70,000 a year in your retirement accounts. $23,500 of that can be Roth, and if you are over 50, there's an additional $7,500 of catch-up contributions. This is so important for business owners because your business is your income making machine, but you're not going to want to work your business forever. What happens if something happens in your business? You want to retire, you want to sell it. Your retirement accounts allow you to take chips off the table in a tax advantaged way, so you can ultimately create financial independence and separation from your business, so you're not relying on your business profits every single year for the rest of your life. Because my bet is, as much as you love your business, you don't want to have to work forever, and creating the retirement accounts that make the most sense for you is going to support that goal of not having to work forever. And last but not least, the number 1 most common tax mistake that I see from business owners is not having a tax planner in your corner. This may be a shameless plug as someone who is part tax planner, part financial advisor, but having a tax planner is different than a CPA who just files and preps your return. A tax planner really looks forward while a CPA looks backwards. And if you can create a relationship between your tax planner and your CPA where there's coordination, and you can look at things like depreciating assets, controlling income, either accelerating or depreciating it, making sure that your estimated payments are on point, and making mid-year corrections, it can free up dollars for you to reinvest back into your business that allows you to make more money. Having a tax planner in your corner is so powerful because taxes are going to be one of the biggest expenses that you face as a business owner. And when you coordinate between your tax planner and your CPA, you're able to reduce these taxes by a lot. So there you have it, 9 of your most valuable tax planning moves that you can make as a business owner. Now, this is so important because taxes are your biggest or one of your biggest expenses. The more that you can keep in your business or in your pocket, the more good you can do in this world. I believe that you, the business owner, are going to be more responsible for each dollar than the government. So therefore, keep more of your money, apply it to solving problems in your business, apply it to making your life better, give the government as little as possible while still being legal. And these 9 tax planning moves are going to be the foundation to help you do that. If you guys found this video valuable, I invite you to join my free school community where I share checklists, videos, trainings, and you can ask me live questions that we cover things just like this and so much more. I'm going to be uploading a tax planning checklist here shortly that if you join, you're going to have full access to. So join the free community, links in the description below. And if you enjoyed this video, hit that like and subscribe button so it can be shared with more people.